Good morning. Good morning, and I want to, great, I've ended the excited chatter in the room. Look, good morning, and thank you all for joining us today for this flash forum on the impact of Trump tariffs on global financial markets. My name's Kate Darian-Smith. I'm a historian, not an economist, but I'm based here in the history program at the University of Melbourne, and I'm speaking here as president of the Academy of the Social Sciences in Australia. I'll begin by acknowledging the traditional owners of the land on which we're meeting today, the Wurundjeri people of the Kulin Nation, and paying my respects to elders past and present. I acknowledge any Aboriginal or Torres Strait Islander people joining us in the audience or online today, and acknowledge and pay my respects to the traditional owners of all the lands from which people are joining in this discussion and this forum. The Academy of Social Sciences in Australia is really proud to be partnering with the Melbourne Institute to host this flash forum that aims to bring expert perspectives to bear in a concise and accessible format. And my thanks in particular to Melbourne Institute Director, Professor Beth Webster, but also to her team. Myron has done a lot of work to bring this together, and I thank him for doing so. Trade tariffs, as we know, have nationally and internationally important implications, are an issue on which the social sciences can bring critical expertise and analysis to bear. And that's not just in the fields of finance and economics, but also in sociology, in political science, psychology, and actually in history, among many other disciplines. And it's very important to, I think, for the social sciences to weave together those various disciplinary perspectives. Our previous collaboration with the Melbourne Institute was a flash forum on productivity ahead of the Australian Government's Economic Reform Roundtable. And a summary of that discussion was received gratefully by the Treasurer's Office. And we hope and expect that some of the comments and the discussion here today will also find a similarly receptive audience. The format for today's discussion will involve short 5-minute presentations from each speaker, followed by a moderated question and answer. And those in the audience, please do save your questions for that question session at the end, not intermittently throughout. And all of those joining online, please post your questions in the Zoom question and answer, and we'll make sure that we get to at least some of those. So I have nothing else to do except to introduce and welcome our facilitator, ABC finance journalist, business commentator Alan Kohler, who you'll all know. I see Alan most nights on the television, on news, but welcome Alan to come forward and facilitate and keep everyone on time. Thanks, Alan.
Thanks, Kate. I won't be ringing the bell, that'll be Myron's job. Thank you for that. Now, before we get started, a reminder that today's event is being recorded. If you're online, you won't be seen or heard, but you can submit questions in the chat, and Beth Webster will ask the question. Kate, you'll be asked anyway. Somebody will ask the question from online. Someone will. If you're in the room, obviously you can ask a question directly. I'll be moderating that. That's my main job. Also, to the online audience, it says here, please note that while you will be able to see the audience, the speakers during their presentation, neither the speakers nor the audience will be clearly visible during the Q&A owing to the room and camera layout. Anyway, let's get going. I've got, there's a few minutes for me at the end to provide a wrap up, which I will try to do. Apart from that, the other thing is that I'm going to introduce all the people now to save time rather than getting up and down each time. And I'd ask the speakers to just say your name to remind everybody who you are. So this is the order of them. Distinguished Professor Renee Fry-McKibben, Centre for Applied Macroeconomic Analysis at the ANU. Professor Giancarlo Corsetti, Pierre Werner Chair and Professor of Economics at the European University Institute. Dr. Prudence Gordon, Executive Director, Australian Centre for International Trade and Investment. She is online. Professor Alan Fells, Faculty of Business and Economics, University of Melbourne, former Chairman of the ACCC, obviously. Eliza Cheney, Co-founder and CEO, Future Forward Australia. Professor Matthew Greenwood-Nimmo, Melbourne Institute, the University of Melbourne. Distinguished Emeritus Professor Warwick McKibben, Director of the Centre for Applied Macroeconomic Analysis, the ANU. Professor Nicole Gillespie, Melbourne Business School, University of Melbourne. And Professor Michael Wesley, Deputy Vice-Chancellor, Global Culture and Engagement of the University of Melbourne. Over to you, Renee.
Thank you. Before I start, I'd just like to say that any of the views that I have in the next 5 minutes are those of my own and not of the RBA on the RBA Monetary Policy Board. And I also just want to acknowledge my colleague Matthew Greenwood-Nimmo and the Australian Research Council for funding some of the work that I've put together for this presentation. So I received a new PhD student this month, Ihan Cheng. He arrived the very first week of October, and he has helped me crunch some numbers on what's been going with Trump's tariffs. So I probably don't even know what my own views are at the moment because we only really just put this stuff together. So I just wanted to start off by showing a graph of this index of trade policy uncertainty. Obviously, Trump's tariffs have created a lot of uncertainty in the economy. The trade policy uncertainty index is this little purple line that's at the bottom of this figure. So you can see around Trump's Liberation Day, which is this first dashed line, the period when Trump decided to shrug off his July tariff deadline and also his 100% tariff threat on China. You can really see that index just rising quite dramatically. I've plotted that against the VIX volatility index, which is the financial markets measure of their expected volatility in financial markets over time. So this starts back in 2017. And we can see that during the COVID period and during the Russian-Ukraine war and the inflation that was a part of all of that period, the VIX was quite high. So around the time of the Liberation Day announcements, the VIX really increased, but then afterwards it's come right back down to really low levels. So this red dashed line across the screen on value 20 is where financial markets see that there's a problem in the VIX and they might be starting to get a little concerned about what's going on. And this is just another comparison with what's going on with the trade policy uncertainty index compared to economic policy uncertainty. So there is some increase around economic policy uncertainty during the Trump era, but nowhere near as much as the rise in the trade policy uncertainty index. And I just wanted to show you what was happening in the US equity indices. So these are 4 different equity market indices starting around 2022. So we have the NASDAQ, which measures more of the technological stocks, the S&P 500 and the Dow Jones, which are more general measures. And then the Russell 2000 index, which is an index of the smaller companies in the US. So you can see that at the Liberation Day, there's still been a really strong increase in equity markets as well. And this is just a figure showing what's happened to other markets. So we have gold futures, silver futures, the Bitcoin index, and that volatility index as well. So while the volatility index of the VIX is really declining to those more calmer levels, some of the other measures that we would usually see that are capturing risk aversion of investors are really increasing. So there's this kind of contrast. So potentially some of those reasons are around gold as a hedge for inflation, and we also see the geopolitical effects coming through of some countries moving out of the US dollar into other assets that maybe are a little bit protected from the geopolitical things that are going on. I know there's a lot of numbers on here, but I'll just really walk you through this slowly. So we did some analysis to look at what happens if there is a shock to tariff policy uncertainty and a shock to economic policy uncertainty in the sample period from when Trump was elected until the 17th of October of this year. So if you look at the very first table, this is showing us how much each of those major equity indices in the US fell at period zero on the day of an extreme tariff policy announcement. So we're looking at the top 30% of those extremes in that index. So you can see that most of those indices really fell by up to 19% for the Russell index, 17% for the Dow Jones index. But they really quickly dissipate. And so you can see that in the second column by period two, there's been quite a rebound up to 22% for the Russell 2000. So I guess this is probably reflecting, is that 5 minutes? Oh. So I guess this is really reflecting the 5 minutes, that's a ridiculous amount of time. That increase. Anyway, I have quite a few slides. I'll just go back to the end one. You can see all my really nice slides. Go back. But basically what we're finding in our results, and we're looking at changes in interdependence between all of these markets, and we're finding that there's new channels of risk preferences occurring that are going from, say, the US during those really high tariff periods to global equities. Asia in particular is affected, and the foreign exchange markets, especially Canada, Mexico, and Korea, are affected with a little bit to the other gold, silver, oil, and a little bit to Bitcoin. There's a surprising reduction in the VIX, so there's that tension there that I think hasn't quite been explained yet. And for Australia, we find that equity markets correlations are stable, but there is more elements of risk coming through investor preferences as well. But we're also finding that commodity and economic resilience for Australia seems to be quite high. So far, in the historical data, so not necessarily looking forward, the major export resource prices for Australia are unaffected. But thank you. And I think...
Thank you. Thank you for inviting me. I just arrived from Florence. That is the European University Institute. Actually, that's my office out there in the Schifanoia. You're welcome to visit. It's a great place. And it's a great pleasure to be here to talk about this topic. I'm going to rely on mostly work that I've done with Bank of England officers that happen to be my students, former students from the Bank of England. So let me just share a few ideas. 5 minutes, I need to talk like an oracle, so just the headline. So three takeaway. The first one, US risk is not new. It has been building up together with opportunities for some time. Second, the atypical response of the dollar to the Trump tariff becomes much less atypical if you consider retaliation, which is the essence of trade war. And then we talk about risk repricing. There's a big risk repricing. Things are not the same. As you know, think about what happened to the interbank market in the global financial crisis. Everything has been collateralized. Now, people buy US Treasury and they hedge. I don't know if that is going to be permanent, but this is definitely a big change in the function of the market. And there are certain long-run risks that come from trade war. First, a permanent increase in uncertainty. Second, a permanent increase in market concentration. I will discuss tonight at the Finch lecture. Third, a permanent increase in non-market risk, uninsurable risk. Fourth, capital controls are likely to come soon. So let me start. You see here to your left, the fact that there's been an increase in the anticipated equity premia in the US. The US has been praised for great equity premia, outpacing all the G7. The G7 has been, the US has been praised for the land of opportunity for equities, outpacing all the G7. Part of that is anticipated, so it is risk. How do we know it's risk? Look at the convenience yield in the US Treasuries, positive at the beginning of the sample, late 90s, zero negative now. So there is long-run risk priced in the US. So far, before Trump, basically, there was no sign of this risk in the dollar. Things have changed with the Trump tariffs. And the point is, as you see in this graph, The Trump tariff, usually we think that an announcement of a tariff would appreciate the currency. I'm not going to explain the reason, but it's well known. But you see, when there is an announcement of retaliation, the dollar actually loses ground. So what we did with the Bank of England, we created a data set of surprise tariff, looking at the possibility of retaliation using like language on the official statement and the press. You see here, like the blue is US dollar, the red is the Chinese currency. When there is no retaliation, the dollar appreciates, the Chinese depreciate. The marginal effect of the retaliation is exactly the opposite. You put them together, there is nothing there. And if you look at the 14 episodes of global retaliation, actually the dollar depreciates. Okay, so there is no surprise there in the fact that the dollar respond weakening or not respond to Trump. Those are impulse responses that René was showing in a graph. Now, what happened in 2025 is something different because all these things have become bigger, more frequent, contradictory, and there is also joining with other stuff going on. So this, again, impulse response is looking only at the tariff shocks. And you see, those are like treasuries. So what happened that together with the same thing as before, the dollar appreciated at the margin with the announcement by Trump, depreciate with announcement of retaliation, the US treasuries, the yields go the other way around. In 2018, they will go down. In 2025, they go up. So, again, what I was telling you before, there is a repricing of risk. And we see the repricing of risk is well known. Everybody has talked about it. The dollar appreciating global shock, has become was traditionally a safe haven. Nowadays, there are signs that this role is cracking. And you see that this big increase in hedging. We don't know whether it stays or not. Maybe Eliza will tell us later. It's difficult to get data on that, as you know, like over-the-counter stuff. So, what is the repricing of risk? So we are looking at the dismantling of the world as we know it. There is no more world trading system as we know from 45 on. And if you think about what that means, remember what this WTO does to life. WTO decreases uncertainty about trade because it's a rule-based. So you dismantle that, there is more uncertainty. So we live in a world with more uncertainty. Second, a world with limits on trade is a world where you cannot really share risk and borrow as much as before. Because there are limits. You cannot run the surplus that you want. You cannot change too much risk through. And also there is a rising probability of default of many countries with higher debt that now will have problem exporting. Third, the lasting effect, fragmenting we are a big world. Fragmenting the world is not a technological problem. Rare earth is a problem for a few years, but will not be in the long run. What is really the issue of fragmenting the world is rising concentration. We give the keys to market power and to politics to a few very powerful corporations that will run the world without any respect to, for the rest. So the last point I want to say is that there is an issue of rising the resilience of free capital mobility because when Trump will see what's going on now with fiscal and especially the external balance that has been losing the privilege of the US, borrowing cheap, he'll get annoyed and will definitely do something about it. And much, much more. I'm not a social, we can talk about politics. The last thing I want to say is that when you talk to corporates everywhere, especially in the US, they say, don't worry. The AI will solve everything. We are looking, so this is a new attitude. It's not fact-based, but it's opinion-based action. So it's animal spirit with amphetamine. So the current point is that don't worry about the fiscal policy. The AI will solve everything. So will be, of course, this idea that AI coupled with crypto financial innovation will even solve the issue of losing ground, the dollar losing ground for dollar exceptionalism. So I've been in Australia. You don't see, but this is surfing. So we are surfing under a big wave. There will be a crash for some real crash, in the sense there is too much investment. This is like everybody knows that people are gambling on this AI thing. The question is, what resilience will be able to, so what will be the source of resilience, and especially what will be the blocks that will be born from this big earthquake? And frankly speaking, we don't know yet.
Hello, I'm Prue Gordon from the Australian Centre for International Trade and Investment. I was asked to speak on implications of US policy for trade globally and for Australia. So in a nutshell, I have to say the implications or the impact so far has been less than many people predicted so far. I'd like to look at the institutional underpinnings for the global trade system, and that's primarily the World Trade Organization and what's happening there, but also the free trade agreements that have built on the WTO and contributed to the greater certainty that has enabled trade to grow over the last 60 to 80 years. So what we've seen in the WTO, and I guess I would disagree a little bit with Giancarlo in as much as we're not seeing disintegration of the World Trade Organization system. What we're seeing is pretty much what was happening prior to Trump coming to office. While the US has absolutely walked away from its commitments in the WTO and from its FTA commitments, and a number of countries have negotiated deals with the US, which similarly are inconsistent with their obligations in the WTO. Trade relationships between everyone else outside the US are continuing based on their obligations and their commitment to the World Trade Organization and a rules-based trade system. I think when you look at the free trade agreements, countries are continuing to negotiate free trade agreements. The European Union has initiated with the members of the Comprehensive and Progressive Agreement for Trans-Pacific Partnership discussions to see how the European Union and CPTPP members can work together. Australia is continuing its free trade agreement negotiations with the European Union, with India. So while the US has walked away, the WTO is continuing. Are there problems with the rules? Yes, they're increasingly outdated. Was this a problem that existed before Trump? Absolutely. Are there problems with dispute settlement in the WTO? Absolutely. Again, a problem that really initiated with Barack Obama and his decision not to agree to appointments of appellate body members. But we've seen the standing up of the multi-party interim appeal arbitration arrangement, which now we had Vietnam join that last couple of weeks ago, making it 58 WTO members who are now pursuing dispute settlement through an ulterior or an alternative mechanism. So irrespective of what the US is doing, other countries are getting on with using the rules that are embodied in the WTO and in their free trade agreements as the underpinning for their global trade relations with other countries. Similarly, I think the effect that we've seen so far is nowhere near as great as we would have expected. And I think if you look at the UNCTAD recent global trade update, that's actually shown a strengthening in trade in the first half of 2025. So there's been an increase, as they say, of $500 billion US dollars in the first half of 2025, despite the volatility. And this is being led mostly by South-South trade. So trade happened before the WTO, before a rules-based system. It's going to continue to happen. And one of its strengths has always been where there's a barrier, companies are very good at finding ways around that barrier. I also think, based on some of the material that's been shown already, the impact on the US economy has not been as great as might have been predicted based on an assessment of the tariff levels that Donald Trump announced on the 2nd of April. I think there are multiple reasons for that, partly because a significant amount of US trade is with Canada and Mexico. A lot of goods are continuing to enter the United States under the preferential arrangements created by the US-Mexico-Canada agreement. We're also seeing companies negotiate deals where the impact of the tariff is either shared or they're ameliorating the impact of the tariff by looking for other sources of supply. I saw this just anecdotally, this wonderful interview with a US importer of copper baths from India, and he'd been hit, his small business had been hit with tariffs of 50%. And he said, well, even though that was materially impacting his business, he said, well, if they say it's good for the country, I guess we just have to suck it up. And I think with 76 million people voting for Trump, I think there's a fair bit of people sucking it up to ensure that what Trump's doing is actually a success, just anecdotally, and something I thought was interesting. But yeah, I think the impact is nowhere near as great as we were expecting it to be. And in many respects, the key question for me then is, and one that we're looking at is, so if the new introduction of tariffs that Trump has announced and his US walking away from rules doesn't actually result in the impact that we would expect, then what does that say about the rules-based system? I mean, I think because countries are continuing to observe their obligations and comply with their commitments in trade agreements, you're not seeing the impact. But at the same time, if we have such an important player as the US walking away from rules-based trade and being able to be seen to get away with that without any major economic impact, then there's a real question about, well, how useful is a rules-based system? I think there is worse yet to come, but so far implications and impacts are quite minimal. Thank you.
Thank you. So I'll finish at 11:30, according to the program. I'm talking briefly on Trump and business. The main features to me are pro-business, America first, substantial deregulation, notwithstanding some particular heavy interventions in some areas, some political factors dealing with the business, especially regarding matters that have a bearing on business. There's a few revenge actions. There's some decisions are for personal benefit of Trump, a very transactional approach in general to business policy, and quite a high degree of unpredictability and uncertainty. Just to elaborate on that a little bit, pro-business, very favourable tax treatment of corporates, including the renewal of the reduction in corporate tax from 36 to 21%, accelerated depreciation, other benefits. Also very pro the Magnificent Seven, the high-tech businesses, Google and the rest of them, NVIDIA. America first, that involves, of course, the tariffs and all the associated deals and broad withdrawals from trade agreements and international obligations with America coming first. We've just heard comment on that. With deregulation, heavy deregulation, oil, gas, coal, drill, baby, drill, other environmental regulation, substantial financial deregulation regarding prudential regulation and consumer and investment protection, also occupational health and safety, and there's more general approach to deregulation across the board, the 1 for 10 rule. If you want to have one new regulation, you have to repeal 10 of them. And then the interventions that I mentioned, notable ones are taking a 10% share of Intel, a 15% tax on NVIDIA exports, mainly of chips to China, the change of ownership of TikTok from Chinese to American businesses favoured by Trump, and other interventions, a great deal, as I've said, of personal benefiting. Think of crypto, for example, but many other personal benefits going through to Trump business, and that also carries over into a lot of the international deals. So that's a few slightly spelling out some of those general points that I've mentioned. Turning to antitrust, which I follow more closely, firstly, the removal of independence from antitrust, the Federal Trade Commission. He's sacked without cause 2 of the commissioners, and that looks as if it may survive the courts. He has also appointed his people to all the regulatory jobs in the Federal Trade Commission, Department of Justice, and the Federal Communications Commission and elsewhere. And they are also taking a somewhat different approach. For example, mergers, now to get a merger, don't bother to visit the regulator. There's a big queue outside the White House where the merger's in effect approved, usually with an accompanying side transaction. Also, typically antitrust has been about looking at the economic effects, particularly on consumers, other businesses, and the state of competition. But now a much bigger factor has been brought in to quite a number of areas where the effect on so-called free speech is taken into account, and a number of media mergers and others somewhat connected with media, including in high tech, they have been handled from the point of view of whether there can be a more pro-Trump approach taken by media organisations. The interventions in the regulators are very considerable. For example, the Department of Justice recently had a number of their middle-level staff removed. But there is a carrot and stick approach in a lot of the regulation. That is, a lot of deregulation, but certain cases are being maintained. Google, Apple, Facebook, and they're sort of seen as bargaining chips by Trump. Australian implications. The Media Bargaining Code is the current government has said repeatedly it's going to bring it back in. That injects money into media, but they've gone really quiet, and we just wait to see now whether they'll persist with it. Pharmaceutical benefit scheme will also come under pressure from the US. We'll see what happens there. So there's just a few. It's, as with all of these things, a high degree of uncertainty. A lot of things being done just don't meet the traditional or textbook standards. The deregulation maybe, but there are a lot of risks in the changes he's brought in, and also general weakening of antitrust and of regulation. So that's a first run at this topic.
Good morning, all. The global economic and financial order runs on something rather fragile, trust. And in President Donald Trump's second term of government, that trust is being stress tested again. We are entering an era defined by two shocks, one economic, the other institutional, and both will shape the future that we are to inherit as young people. The economic shock we've heard a fair bit about this morning already, and we hear about a lot in the media. In April 2025, the Trump administration imposed a universal 10% tariff on imports from Australia and sharply higher duties on others. These rattled global markets and supply chains, and for Australia, the direct impact may or may not come through China, where effective tariffs are now averaging about 55%, which could raise prices and complicate the RBA's fight with inflation. For young Australians, this means something quite visceral. It could be a harder start in what is already a bleak economic landscape with higher costs, slower job creation, and a diminished confidence that globalisation delivers opportunity rather than uncertainty. Yet not all assessments are grim. Some argue that Australia actually may emerge a surprise winner, spared the worst of the tariff regime and positioned to benefit from new trade flows. We could see increased competitiveness in beef, LNG and critical minerals as global firms potentially pivot away from the US-China axis. So the picture is not necessarily one of collapse, but of recalibration. And this recalibration might also mean rethinking our dependencies. But beyond the trade data lies a more subtle shock, a confidence crisis, an erosion of faith in the institutions that hold our economic and financial system together, including our domestic governments. The loss of trust doesn't just cut across borders, it cuts across generations. Polling has shown that 43% of young Australian men would vote for Trump if they could, and 50% believe that his presidency will have a positive impact on the global economy. I would argue this is largely driven by disillusionment rather than jump to accuse all Trump supporters of being ignorant. A signal that young people, especially young men, no longer see existing institutions as necessarily delivering for them. And when young people lose trust in institutions, when they see worsening economic prospects, inequality, instability, they are more likely to reach for simple answers to complex problems. The erosion of trust in the status quo breeds polarisation. It fuels intergenerational anger and it tears at the seams of the social fabric, undermining our egalitarian compact that has defined modern Australia. Young people are at greater risk of being drawn to these extremes, to the easy certainties offered by those who seek to divide, on both sides of politics. Young people have always been the champions of progressivism, of climate action, social justice, peace. But this progressivism has never meant abandoning the desire for prosperity. We want to build lives of purpose and security, to provide for our families, own our own homes, to thrive, not just survive, in an economy that works for all of us. The shift we're living through demands that these two instincts, idealism and pragmatism, work together. Recalibration means designing policy for an economy that lets us pursue both fairness and freedom, sustainability and security. Through the organisation I co-founded earlier this year with my partner Mac, Future Forward Australia, we are already starting to see young people starting to turn this frustration into action. We are building alliances across advocacy groups, facilitating policy conversations over beers at the pub, and increasingly demanding a seat at the table where discussions and decisions about our future are being made, such as this. We are proving that we are not passive, that the answer to a confidence crisis is participation, and the answer to an unstable economic outlook is adaptation. We know we can't control Trump's tariffs or the retreat from the global order that we've grown up with, but we can decide the kind of Australia that we build in response, one that is outward-looking, resilient, principled and fair. We can strengthen our comparative advantages in green exports, building renewable-powered AI and data infrastructure, and deepening our clean energy supply chains. We can reduce our reliance on the US while positioning ourselves as a trusted middle power, one that bridges divides rather than deepens them, and creates opportunities for our next generation. The world we inherit will not be easier. It will be harder, faster, and more fragmented than ever before. But we are a generation that is already in the storm. The question is not whether we can endure it, but it's whether you will include us in helping to steer it. Because the trust we build will not just be from youth movements alone or from academic discussions. It's about a shared intergenerational belief that the future is still a collective project worth fighting for. Thank you.
Well, I'd like to open by saying what a terrific talk that was. Very impressive. It was my decision to invite Eliza to speak because I thought it was really important that we hear a youth perspective, given that so much of what's going on at the moment has implications that will last into the future. So much of what is changing right now will be dealt with and lived with by people who are, by and large, not heard loudly in the conversations today. So I'm very pleased to have heard a really impactful talk by Eliza. Great talk. Well done. My talk kind of echoes a little bit of what Renee said, but with a slightly different flavour. You can view this as kind of confirmation that these 5-minute sessions are not pre-scripted. They are independent. The idea is it's an opportunity for a group of experts to speak about the foremost topic on their minds. So the foremost topic on Renee's mind was uncertainty. You can see what the foremost topic on my mind is as well. But the flavour is a little bit different. So on the slide, you can see four panels. These reflect, they show the economic policy uncertainty for the world in the top left, the US in the top right, China in the bottom left, and Australia bottom right. So this is basically an index. There is a source down there if you're good at squinting. There's a website, policyuncertainty.com, that you can get the data from if you're curious. These are indexes of how much news coverage there is of uncertainty as it relates to economic policy. So you can see the sample period plotted spans from January 2000 through to September 2025. The most recent month is not available. But you can see there's a tremendous spike in economic policy uncertainty basically all over the world. The Chinese pattern's a little bit different, but there's still a huge spike in 2025. And no surprises, that corresponds closely with the Trump tariff announcements in April. So this, looking at the picture, you can sort of see that uncertainty is high globally, but I think it's uncontroversial to say that the primary source of economic policy uncertainty over that period is the US. It's an unpredictable White House that changes policy rapidly and doesn't clearly signal the future agenda. It's very hard to draw inference about what will happen next month based on what's happened this month from the White House. I wanted to kind of dig a little bit deeper. So what this index shows is a disaggregation. It breaks down that economic policy uncertainty index for the US into components. You can see they're lined up across the bottom: monetary policy, fiscal policy, etc. The green line is trade policy uncertainty. So there is naturally, as you would expect, a huge focus on trade policy uncertainty at the moment, given that enormous spike. But one thing that's hard to see from this chart, or maybe buried by the scale of the chart, is that trade policy is not the only relevant uncertainty at the moment. The next chart, it's exactly the same. I just delete the trade policy line so that you can see what's going on with the rest. So you can see there's actually an escalation in all sorts of policy uncertainty, economic policy uncertainty, since the latest Trump presidency. So through 2025, you can see large spikes in monetary policy uncertainty, in national security uncertainty, fiscal policy uncertainty, regulatory uncertainty, and the uncertainty around currency crises and sovereign debt. Now, that's kind of very relevant when we think about the impact that all this uncertainty is having on financial markets. So typically, in a period of uncertainty, investors tend to reach for safe haven assets. We've heard that referenced in talks earlier by Renee and also by Giancarlo. The pattern usually is that investors tend to reduce their exposures to risky assets like equities and increasingly move their money into safer assets like gold, like cash, and ordinarily like government bonds. Those are typically viewed as safe assets. So in an uncertain time, in a risky time, investors tend to reduce their exposure to risk, move towards safer assets. That's not so clear-cut this time, which is surprising in some sense, because you've seen, if I jump back, the level of uncertainty is unprecedented, the level of policy uncertainty. So why aren't markets responding kind of as you may expect? We've already seen from Renee in her talk that the VIX, which is the investor fear index for the US, is actually low at the moment, despite high levels of policy uncertainty. So the action that we're seeing right now is basically that stock markets around the world are bullish. They're pushing towards records or at records. Gold and silver are both booming. Those are traditionally viewed as safe haven assets. Gold has set record highs, and I think silver is very close, if it's not at a record at present. So you're seeing a stock market that's booming. You're seeing booming demand for sort of safe haven assets with a tangible, practical value. You know, they're physical things that you can hold. US government debt's an interesting one because the question I think a lot of investors should be asking themselves is it still a safe asset? Are US government bonds as safe as they used to be? I think there's no question it's still, in a comparable sense, still a safe asset, but it's not as safe as it once was. So I think investors should be starting to question long-held cherished beliefs about the stability, the perceived stability of US debt, especially when you look at it in the backdrop, against the backdrop of a very volatile White House, policy uncertainty that's very high by any measure, kind of unprecedented frictions with major trading partners, and a gradual disassembly of many aspects of the world order. The reason I think that that you're not seeing the financial markets responding quite as sternly as they may is that many investors are simply gambling that politicians are bluffing, the so-called taco trade, which stands for Trump always chickens out. So they're betting that all of his announcements, not just Trump's, I have to say, it's not only the White House, they're betting that these really stern announcements that are coming from politicians globally are not going to translate into concrete action, that you're going to see something which is more moderate. There is also another part of it here, which is that tariff uncertainty and broader policy uncertainty makes it hard to distinguish signal from noise. There's sort of a smoke screen around the action, especially in the White House at the moment. It's a bit of a smoke screen that's obscuring the actual actions that are going on because the announcements don't necessarily correspond to what you see on the ground. But I think the big question, the big concern that you have to keep in mind is that tariff policy has long-lasting effects, for example, on companies making long-lived investments and supply chain decisions, and beggar thy neighbor policies make everyone poorer in the long run. So while you're seeing these booming stock markets, you have to question whether that corresponds to a rational assessment of the long-run prospects of the economies that those stock markets capture, the firms that they represent. Investors appear to be discounting adverse scenarios, attaching zero weight to them effectively, and they could be caught out badly if they materialize, which poses potential financial stability risks.
What I want to talk about in the next 5 minutes is work we've been doing at the Peterson Institute for International Economics on Trump's trade war. We've done a lot of studies, and we actually did the first one before the election, and we asked the question with my colleagues, Megan Hogan and Marcus Nolan at Peterson Institute, what if Trump wins the election? So we did a series of scenarios looking forward, and the key issues we focused on were trade wars, deportation of US workers, undocumented workers, and taking over from the independence of the US Federal Reserve. Those scenarios are still live, they're still valid. What we are doing now is we're continually updating, as a public good to policymakers around the world, the results from our global economic models about the impacts of certain announcements as they're made on the macroeconomy, on the sectoral composition of different countries around the world. And policymakers have been using this extensively. The model we're using is called the G-Cube model. That's all you hear about it. It is publicly available. It's open source. The shocks that we have been updating is working with Chad Bowen, who was in the Biden administration chief economist at the US State Department. They're updating actual tariff rates in real time. The key point from this is that even though you hear the tariff might be 50% on Canada and Mexico or 25%, the headline tariffs are totally different to the actual tariffs when you look at the individual sectors, the exemptions, the carve-outs. USMCA agreements take the Canadian tariffs from around 25% down to about 4%. The Mexican tariffs very similarly. So there's a lot of detail that's actually more about bluster and public relations than it is about actual tariffs. When you look at the actual tariffs, which is what we're doing, the economic impacts are a lot less on the direct impacts on incomes and prices. I'm not dealing with the uncertainty that Giancarlo and Renee and Matt have talked about, but in fact, you can overlay this. This is just what happens in the economy if you put on a tariff on certain goods from certain countries. What we learned from this analysis is that the US does experience an economic slowdown from the tariff shocks. At the point of the last study, which was September the 11th, the US economic slowdown is about 0.6% of GDP. So if the US was going to grow at 3%, it would grow at 2.4% over the next 12 months. So the idea that the US was going into a deep recession, it's not consistent with the empirical work, at least that we've done. Inflation, about 1% higher. So if inflation was going to be 3%, by the middle of next year, it'll be 4%. What we also find is the more severe the tariff war, not surprisingly, the larger the economic slowdown and the bigger the inflation shock. Retaliation makes things worse, both for the retaliating country and for the US. And Giancarlo's point about the exchange rate's an important one. The US dollar should have appreciated. It didn't. Countries announced retaliation, which is part of the story. We also had the big budget busting bill, which was a massive fiscal stimulus. That should appreciate the exchange rate because you have to finance it and it will be financed by foreigners. You have the concern about the independence of the Fed, which should bring down the exchange rate. You saw a whole range of investments by data centres, 2% of GDP last year of spending on building data centres. That stimulates the economy. But if it doesn't generate productivity growth, that's a big hole that's going to actually be filled at some point. So what we also find in the spillovers, so some countries actually gain from this tariff war. It depends on your tariff relative to other countries' tariffs in the US market. It depends on who you trade with. So, for example, Australia is a net beneficiary of the US tariffs directly because our agriculture gets a better tariff than agriculture from Brazil. But we get a negative shock, which is bigger, because our exports of mining and energy to China go down because the tariffs on China are much bigger. So the complexity is actually really, really large. It depends who you're trading with. It depends what you're trading. It depends on what's happening to your trading partners. And it depends on whether you're a large external debt or not. And that's also a key factor. So what I was going to do now is try and do this. This is the website where we produce the material that's available, publicly available globally. We have a lot of things in here, including the documentation on the model, but we have the economic scenarios, and we can go in there and you can take the latest scenario as of the 11th of September. And this shows you the macro financial markets and the sectoral compositions of all the major countries in the world economy. I just want to use this to point out a couple of important points. When you look at the results for the US, please work. Okay, excellent. So on these charts, there's three lines. The blue line and the red line is the original analysis we did in September last year. We didn't know what the tariffs would be, so we asked what would be the worst possible outcome and what would be the lowest possible outcome. The black line is where we are right now. Well, actually 2 weeks ago, and it's changed since then. And what you can see is this is the deviation in agricultural production relative to what it would have been. So 1% fall means that production in 2025 will be 1% lower than it would have been. So for US agriculture shrinks by 4% relative to what it would have been. The jobs that are being lost in the US economy are in agriculture and manufacturing. Why is that? US has a lot of trade in those sectors, and the tax on imports is a tax on exports. So your export sectors get hurt by their policies. The input costs that these industries are subject to are largely driven not just by domestic wages, but by imported inputs. And so they've got a cost shock, they've got a negative demand shock. So these economies, these sectors slow down. The two that are most impacted, agriculture and manufacturing. Who is Trump's base? Agriculture and manufacturing. And you might say, well, yes, it's just a model simulation, but the number of jobs in manufacturing today is less than it was when Trump won the election. And 20% of US farmers are on the verge of bankruptcy at the moment, especially if you're a soy exporter, because soybeans, 80% of US production of soy goes to China. China imports nothing from the US. So these results are turning out to be frighteningly accurate, and people saying, and I'll finish up here, well, we're not seeing it yet in the data. Well, remember, these tariffs were anticipated. So when you saw a surge in imports in January, February, March, people were bringing in imports in anticipation. How big was that surge? US GDP was negative in that first quarter because imports rising reduced GDP. GDP then rose as people came out of that, and they're claiming that's because of Trump's policies. No, that's because imports that were brought forward were no longer in the second quarter data. So you've got to be very careful looking at the data and claiming it's success or failure. So go back and look at these graphs in 6 months' time, and I agree with Giancarlo, there's a big shock coming, and we just don't know when. Thank you.
Hi, it's good to be here. I'm probably one of the only non-economists in the room. But the argument I want to make today is that the Trump tariffs have a significant strategic rationale, quite apart from the economics. And it's important in trying to understand their implications to think about the strategic effects of what's going on. This, of course, raises the question of whether Donald Trump has a strategy, and if what you mean by strategy is a conscious, consistently applied plan. Arguably, Donald Trump has never had a strategy in his life. What he does have is, I think, instinct and impulse. And I think you can see that there's a consistent instinct and impulse behind what Donald Trump's doing. I think his impulse really, as President of the United States, is to arrest the long-term relative decline of US power. It's the foreign policy strategic component of MAGA, if you like. Basically, I think what Donald Trump is doing is using unpredictability to cash in on long-term US structural power. So he's trying to, in strategic terms, monetize in the short term, long-term structural US power. Trump 1.0, according to what I'm seeing, showed him that in a world geared towards predictability, all of the rules, all of the agreements, all of the institutions since the end of the Second World War geared towards guaranteeing predictability. This is a world that can be exploited by systematic unpredictability. And I think Trump 2.0 is trying to systematically implement this in a consistent way. There's a long tradition of this in strategic thought. The fact that power flows from unpredictability in conflict situations. Thomas Schelling was writing about that in the early 1960s. Unpredictability and irrationality bring advantage, at least in the short term. So I think you can make the case that Trump's tariffs have a powerful strategic rationale. They're about a number of things. Firstly, they're about regaining the strategic and diplomatic initiative from China. I think Trump and many in the United States see China as having seized the initiative internationally in the 2010s. It's about reinforcing the awareness of the centrality of the United States and particularly the US economy in global affairs. It's about emphasising the underlying tech ascendancy of the United States economy that we've seen over the last 20 years. And it's about asserting new forms of extraterritoriality, particularly through things like transshipment tariffs that are being applied in Southeast Asia and elsewhere. Ultimately, I think Trump has a much more integrated view of the fusion of US economic power and strategic power than any of his predecessors, probably going back to Richard Nixon. I think that there is evidence that the rush of countries to sign deals with Trump after the imposition of tariffs has the short-term effects of emphasising US power, and that means that Trump will continue with these tactics. It plays into his game to have countries rushing to sign deals. The question, I think one of the questions is whether it will lead to sustained efforts in places like Southeast Asia and Europe to become less reliant on the United States. And I don't think we can see very much evidence of that either. The other big test, I think, for Trump in all of this is how China responds. Whether China decides to respond with accommodation or competition. And I think, and again, I would defer to the economists in the room, I think the evidence is unclear and mixed at the moment. Thank you.
In case you're wondering, that wasn't Nicole. That was Michael. Nicole isn't here. Okay, so we've got time for questions now. Hands up.
I've got two
Beth.
online, Alan. Do you want me to?
Two online. Let's go with them.
Okay, from Luke Chandler. It's a question for Professor Corsetti. You warned about the erosion of the US dollar's safe haven status. How realistic is the prospect of a multipolar global currency system emerging in this decade versus a de facto commodity like gold in the currency market? So do you think there's going to be a multipolar currency world and instead of the US dominate? Currently the US dominates. Are we going to have a multipolar global currency system, or are we going to just sort of zero in on gold or something else, something worse? Crypto?
This is for you.
Okay.
About the multipolar currency world. Go.
This is not subject. I cannot really do forecast on this. Like we could do Bernanke style scenarios analysis. The short answer is we don't know. The dollar is going to be there to stay for some time. There is nowhere else to go. If you look also at the supply, so for some time there will be possibly the dollar and possibly run on gold, followed by crash and then some. So the multipolar, we don't know how it works. It may well be. And it's linked to what Prudence Gordon was saying about these new emerging blocks with perhaps some form of rule-based within the blocks, provided the US aggressive stance allow that, because there is also this other issue. So the short answer is that I don't know.
I would just add that China is demanding that some of its customers pay in renminbi, which appears to be the only real move away from the US dollar that's going on in the world at the moment. We're certainly not going to gold, in my view, not going to Bitcoin. No, gold is just a speculation, right?
No, even if you look at the Turkish export to Russia, Turkish exporters are not subject to sanctions. But to my surprise, there was a move from dollar to Turkish lira, but not massive, to stay away from the sanction. There was a move from other form of payment to cash in advance. You deal with the belligerent. So at the margin, they're all this, but not enormous. Also the same thing, the renminbi is at the margins there, but it's not enormous.
Can I just add to something you said, because it's not, if you look, Alan, at what's happening on the gold side, central banks are definitely substituting their reserves away from US dollars to other currencies, in particular the Swiss franc, the Australian dollar and gold. So a lot of not a lot, but a fair part of the fundamental demand for gold is coming from central banks, and
yes,
that's forecastable as soon as Trump won the election.
Yes. Well, were there two questions or one?
Well, there's another one. There's another one from a separate person. Shall I ask that one? Or
no one else got their hand up in here, so.
Okay. This is someone anonymous. Are we seeing a shift from globalisation to regionalisation? And if so, what does that mean for Australia's trade and innovation strategy, especially if we're going to go in big on rare earths? Shouldn't we secure our own supply chain for things like data centres?
Does anyone want to pick up the microphone on that? Okay.
Yeah, so what's been happening, Trump is an anomaly to a trend that's been going for a long time, and that trend is actually moving the world economy away from the US to the growth centres of Asia. And so that's already underway, and Australia's been well placed to diversify its trading partners. We've been at the leadership of APEC, of various other international forums. So I think from Australia's point of view, this is fine. We don't really need the US economy from a consumption base, because we can sell what we sell. Instead of selling beef for hamburgers to the US, there's a big demand for beef coming out of the newly emerging countries. So I think Australia is well placed. One of these mistakes we might make is trying to actually pick what commodities or what sectors we think the growth will be in. So we might think it's a really good idea to keep digging up iron ore, and we can keep selling it, even though we have the tyranny of distance, by transforming it into using green technologies. But maybe we shouldn't be doing this sort of technology. We should be thinking that we're exporting data, for example, and building data centres here. There's no tyranny of distance. because there's no trading restrictions based on large commodities. So I think we've got to think more carefully than taking existing industries and trying to transform them, than to build a framework where new industries can emerge quickly and we could take advantage of these new technologies.
Anyone in the room? Oh. Do you want to just say something?
One thing we should keep in mind, the decline in the relative GDP of the US is exactly the reason why the rule-based multilateralism is not working anymore, right? It's like it's very difficult to rule the world by a soft approach if you're smaller and smaller. And at that point, there is a shift completely. Now, what we don't want is blocks of the type we saw in the interwar period. There's a beautiful paper by Kevin O'Rourke who show the effect of colonialism in creating lots of trade based on rare earth material. So this is actually one of the major things that may happen, which is a regionalization that does not come from free trade and comparative advantage, but comes also from strategic control of certain things that the different blocks may feel necessary.
Thanks. Henry Williams. I'm at a new think tank called Policy Institute Australia. Got a question for Prudence Gordon or others. Very interested in your 2-year and 5-year prediction for what happens with the WTO, or how people are dealing with smaller countries and bigger countries are dealing with whether they're going to stick to the low trade system or whether they're going to need new mechanisms to do that.
That was
for answer that. Yep. So I think what's going to happen with the WTO is a continuation of what has been happening, and that is a shift to plurilateral agreements. So there is a heightened focus on trying to reform the WTO, and there was a sense that with the uncertainty created by Trump and his shift to unilateral policy and tariffs on the trade space, that there would be more incentive for countries to cooperate and enable reform in the WTO. I don't see any evidence of that happening. All the same blockages that existed within the WTO before Trump remain. But so to get round those blockages in the past, countries moved to plurilateral. So the Joint Statement Initiative on e-commerce was recently concluded. The Investment Agreement for Development was concluded and I think signed by about over 90 WTO members. So countries will continue to find ways to create new rules around new issues and progress them outside the formal structure of the WTO, but continue to look for ways to bring them back into the multilateral system. I haven't been able to do that yet, but I think it'll just continue doing that. But I think the framework that the WTO provides will remain important, and the forum that it provides will remain important.
Thank you. Hi, Jeremy Van Dyke from the Department of Climate Change, Energy, Environment and Water. I had a specific question for Warwick. I'm particularly interested in the modelling, and I've seen you present on this before, but you talked about the impact of tariffs specifically. I'm wondering to what extent what you showed and your modelling more generally accounts for other factors such as particularly the crackdown or attack on, depending on your perspective, on foreign labourers in the US, which is particularly important for agriculture and manufacturing. And if that's accounted for, or what, you would say about that more generally. Thanks.
Yeah, thanks, Jeremy. I forgot to mention this, and I'm glad that you asked the question. So of the shocks we looked at, the tariffs are the minor part of the adjustment that's going on in the US. Just look at the US deportation. They're talking about maybe between 1.3 and 8.3 million workers, undocumented workers. Where do you get those numbers? Well, you get them from Operation Wetback, which was the last time the US deported workers of around 1.3 million equivalent. But if you look at the number of undocumented workers, it's somewhere between 8 and 12 million. How big is that? That's 5% of the US labour market. That is 16% of US agriculture. That's 18% of US construction. When we stick that into our models, that's like 2 or 3 COVID events at the same time but the workers don't come back, right? They're all dead because they're gone. Now, is this plausible that our scenario is credible? Well, actually, if you look at this Congressional Budget Office, which brought out their new demographic projections for 2025, there are 2 million missing workers over 2025 compared to what was forecast in 2024. 2 million. That's about 1.3% of the US labour market. Where are they? About 3,000 workers a day is the target for deportation. That'll give you 1 million workers over a year. There are people not coming to the US, so net migration is now negative, which means it's not just low-skilled workers that aren't getting on boats. It's professors, it's industrialists, it's inventors, it's H-1B visa holders who aren't coming now to the US. And the third group are the workers who are in the US who are doing low-skilled jobs that are too scared to go to work. So they're not turning up. They're not paying their taxes because they're not getting any income. So this labour supply effect, when we model it, you add that to the tariffs and you add that to taking away Fed independence, then the US does go into recession. But the good news from that is that the capital that would have gone to the US because of the high return of the workers is going to go somewhere. So it comes to Australia. So in those scenarios, Australia, Japan, Asia attracts the foreign capital over the next few years that would have gone into the US, and that's actually reversing the fact that capital tended to flow uphill instead of downhill. So now the US shrinking dominance in the world is going to now accelerate to a relocation of global capital if we get it right. And there'll be a lot of policy adjustments that are needed in countries that are receiving this capital.
Thank you very much. My name is Tokuro Furui. I'm a Japanese consul general here in Melbourne. And my question towards Eliza Cheney, and I really appreciate your view on from the young people's mindset. And my question is, if I understand what you said, is that these young people may have some kind of distrust towards the existing system, and if I remember correctly, you said that the young people are outward looking and also resilient, the kind of the new type of the forms that are waiting. And I have a strong interest about what you said about the outward looking, since I think that usually people say that the younger generation are more inward looking, at least in Japan, and I do not know whether this is true in Australia, but you mentioned about outward looking, and therefore I am very curious about how you see that this outward looking young generation may see what kind of the future in the kind of the traditional WTO type of the things, or the kind of the more bilateral or the reciprocal type of the trade things. Thank you.
Thank you. Thank you for your question, Consul General. So I think the words I used about the outward looking and resilient is kind of, I guess, what I see as a vision for Australia's future personally. But to kind of speak on your point about young people, I don't know if all young people are outward looking. Of course, I can't speak for all young people. But from at least what I observe in the conversations that we have in my role at Future Forward Australia, and just sort of, conversations that I have with peers at university and at the pub and wherever, I think naturally as Australian youth, we have to be outward looking. We are a smaller economy compared to the United States. I studied in the US, and a lot of them couldn't name a single Australian city, whereas I think there are many, many young people who can very easily name the President of the United States, perhaps even more likely than naming who our own Prime Minister is, anecdotally observed. So I think, as Australians, we have to be outward looking. I think the way we consume media and the news is, owned by international companies. So I think naturally we have to be. And I think the future for Australia is to continue to be outward looking and to continue to and I think, what Warwick said about, there might be, we should maybe be paying more attention to our neighbours in the Asia Pacific, more so than the US and Europe, which historically I think we have done. So I think young people, we have to be outward looking. We have to engage with the world around us, not just in Australia. perhaps we could do better to also engage with what goes on at home. And I think actually sometimes our election results and political sort of outcomes show that young people aren't paying enough attention to kind of the domestic environment and can't explain or tell us what an interest rate is, but they can very sort of, detailedly explain the US election results. So yeah, hopefully that answers your question.
Yes, you certainly are.
I also want to ask it of Warwick. So you're describing capital outflows as coming into places like Australia and developed countries, but surely there's a big labour and capital injection into poorer countries from, like, say, Latin America, where maybe all the immigrants are going back to. So they must have a big boost as well to their own economies in your simulations, do they?
Yeah, so that's a good unscripted question.
Good point.
So in the scenarios where we're deporting people in the simulations, we're deporting the people and we're actually not sending them to other countries. We're putting them in military camps along the border of the US. Because you're right about the point, if they go home and they bring human capital, that's actually good for the rest of the world. But there's an enormous expense in rounding these people up, which we don't take account of. And there's also an enormous expense in deporting each person, like hundreds of thousands of dollars, which we don't model. So it's really just taking the workers out of the US economy, and then what does that mean for the US economy in that particular scenario? But it's a good point that there's a lot of these other issues that if you seriously find they're getting close to 8 million, which we're not at the moment, but you could easily get there, then that's a serious issue.
One other.
Thank you. Yeah, Pete Annan. The governance guardrails are largely being dismantled across the financial markets in the US, and conflict of interest seems to be kind of done. What's any assessments on that, what that's going to mean for financial stability and resilience across the financial markets in that kind of situation?
Who wants to answer that?
Yeah, there is, among monetary economists, there is this idea of working about dominance, monetary dominance, fiscal dominance. We are going into a new world where there will be a complete change in the power of this institution. And my personal view, which is not a forecast, is that at some point, the financial innovation and cohesion will not be enough. There will be some kind of fragmentation. And there is an obvious link between trade fragmentation and financial fragmentation. So I will not be surprised if taxes or capital controls are coming from the US. And if I make a comment on Michael, there is a fundamental narrative that he used to shape policy. And this narrative is not up for criticism. If you try to criticize, you're dead. The narrative is that we are the largest market in the world. The other countries took advantage of to sell their products and finance their growth. We are the largest financial market that other countries take advantage of to do their business. We are the largest income opportunities for migrants. That people come in like criminals to take this thing. We offer military coverage, and the other guys are not sharing the burden. We offer financial aid to poor people, and these guys send their criminals to our thing. We can go on. Every single aspect of life is dominated by this grievance narrative. And let me misquote Cooper. The problem with tariff, or the problem with Trump, is not retaliation, it's emulation. And I completely agree with Prudence Gordon. We are not saying something different. We need to work on keeping things up, but it's not going to be easy in this world where this narrative goes into white male feeling discriminated, into anti-Semitism as a way to crash universities. So it is a little bit of a different world. The battle is not lost, but it's a battle. And it's not, that's why what is make very difficult to forecast.
That seems to be a very, very good note to end on. And I've been asked to give a couple of minutes to end with. I don't have much to say, except that I agree with Michael Wesley that this is not mainly about trade. Tariffs are mainly about the projection of American power, particularly in relation to China. And Deng Xiaoping said in 1992 that the Middle East has oil, we have rare earths, and what we're seeing this year to some extent is a kind of an oil shock, like we had in 1973 and then 79, I think, and America is responding to that. I mean, the trouble is that the tariffs are mixed up with a whole lot of other stuff, you know, unitary executive theory being imposed, the crackdown on immigrants, you know, everything is, it's very difficult to kind of discern what's going on. So I spoke this morning to a guy who runs a company called Sunrise Energy Metals. He's got a deposit of scandium in the middle of New South Wales. It's the world's largest deposit of scandium, which now is a critical mineral. They're getting money from the US Exim Bank to do this. He says that the agreement with the agreement between Trump and Xi Jinping this week will involve a 12-month pause on China's crackdown on rare earths and critical minerals. That's basically what's going on. Well, Trump is using the tariffs to achieve a 12-month pause on the withdrawal of Chinese rare earths. But this guy I spoke to this morning says that won't be long enough. It's going to be 3 years till he gets to production in 2028. And, you know, and then he won't be making that much of it, but it'll be a fair bit. And that sort of thing's going on across Australia. There's going to be a lot of money going into, billions of dollars going into these critical minerals operations in Australia to replace China. I mean, just finally, the question is why does the US have to replace China? Because America doesn't trust communists. Basically, they don't trust China. China doesn't trust America, so there's been a breakdown of trust, and that's going to have to take place. I mean, we could just keep buying China's critical minerals because they're cheap and they're very, very environmentally harmful. So they don't care about that. They're just making the stuff. But apparently we can't keep buying it because we don't trust them. Anyway, that's it. Thanks very much, everyone. Thank you for the presenters. And lunch is out there.